Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So my wife and I were gone for the past week. We were visiting Virginia, got to see all of Colonial Williamsburg and the surrounding area. It's a beautiful, amazing place. We had a great time. And go figure, while I was gone, the stock market was just horrible. Basically what happened is we were getting close to having a trade deal with China. And it appears that the deal that had been negotiated by both the U.S. and Chinese negotiators was sent back to China, and then they decided, the powers that be, that no, that wasn't quite the deal they wanted. So they started talking about things that they wanted to change, and that's when the Twitter storm happened. And that's actually what this week's update is all about. Is now, as a result of the fact that that China deal didn't complete as it was anticipated to complete, what we find ourselves in is a situation what the media calls a trade war with China. Now, if this sounds a little like deja vu all over again, it's because it sort of is. Because the first time that the Trump administration started to apply tariffs on China as sort of a penalty for not treating us fairly, at least in their opinion, in the global market. The economists and the media predicted the end of the U.S. economy. It was, those tariffs that we were placing on China and that they were placing on us were going to harm our economy. And fast forward, and what happened in the first quarter of 2019? 3.2% GDP growth. So what's new about these tariffs? Well, it looks like this, so there's sort of two facets to this. There's what kinds of tariffs we're going to put on stuff that we buy from China, and we're increasing those tariffs up to about 25%. And then China immediately retaliated and said, hey, look, we're going to increase our tariffs on the stuff that you sell to us, and they're going to increase that up to maybe 25% too. So I just want to take one of these numbers, and let's start with there's $60 billion of goods and services that we sell, or that China is putting tariffs on, and they're increasing the tariff rate from between 5 to 10% to between 20 and 25%. So let's just say it's from 5% to 25%. We'll take the extremes in both situations. So the amount of tariff, 5% of $60 billion is $3 billion. 25%, that's the new tariff rate of $60 billion, is 15. So really the tariffs are going to go from $3 billion a year to $15 billion a year, or a $12 billion increase. Now some would argue, oh my gosh, that's going to hurt people in an amazing way. It really is. This trade war is just going to be horrible for the economy. So again, it's $12 billion, and the GDP of the United States is over $21,000 billion, or $21 trillion. So I challenge you, go grab your calculator, and what percentage is 12 billion out of 21,000 billion? And when you put that in your calculator, the number is going to be so small that it probably won't even give you a percentage. It'll give you something called exponential notation, which is something that you're not going to be able to read. Long story short is these tariffs, while not pleasant for some people, like soybean producers, they're not going to crater our economy. They are a rounding error to the U.S. economy. Now let's talk about people like soybean producers, because they are being shown as, oh my gosh, these tariffs, they're not going to be able to sell their soybeans in China. It's a horrible situation. And as a result, those soybean producers now have a surplus of soybeans, which has caused the cost of soybeans to fall 20% in the United States. So what does that mean for companies in the United States that use soybeans to manufacture some of their foods? Well, that means that the price that they pay for soybeans has also gone down, so their profitability goes up. Long story short, this is not a situation where it's one side wins and one side loses, or there's a lot of give and take here. But in the grand scheme of things, these tariffs are not going to crater the US economy. They're a rounding error. They're very real to the people that are being directly impacted. But when you think about, what drives the US economy and therefore the stock market, it's sort of the macro numbers. It's not some soybean producers in the Midwest. It's the macro numbers. It's what's going on in the United States of America. And with a 3.2% GDP growth in the first quarter and $21 trillion of total GDP, this trade war, while uncomfortable and certainly it's not helpful to the stock market, over the long haul, as sort of cooler heads prevail, people will start going back likely to valuations. And as they say, this too shall pass. So long story short is, don't let the volatility cause you to make decisions to sell or buy simply because of greed or fear. It's something that we advise people on all the time. Don't do it. It's not worth it. Follow the math. And the US economy is still strong and will continue to be strong in spite of these tariffs. If you have any questions about this or anything else investment related, you can always give us a call. We'll be happy to answer any question you might have. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thank you for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.